Hello, I'm Yiorgos Allayannis. I'm on the faculty at the Darden School at the University of Virginia. And with me, I have Mr. Toni Crescenzi from PIMCO. And we are at the University of Virginia Investing Conference. And Toni will share some thoughts about the bond markets more broadly. So, Toni, if I may ask you, what do you think the rates, where are they going?
The public is very worried about rates. I've traveled the world literally, and it seems to be the top concern amongst investors these days, whether yields will keep rising, because for 30 years they've been falling since they peaked about 30 years ago. And so the yield on the U.S. 10-year, for example, whereas it was at about 1.4% at its low point, today it's at about 2.7% or so, trading in a range of between 2.5 and 3. But people worry that rates will go up a lot more. So they're worried about their bond investments. They've been investing in bonds for a long time, and yields have been falling, providing a tailwind to prices, giving them pretty good returns. And given that bonds tend to be less risky than stocks in terms of their volatility, that was an attractive prospect for them to buy low-yielding instruments with good return prospects, because the prices were rising in addition to the yields they were receiving. And so the outlook now is a little murkier. PIMCO believes that interest rates will be rising, but very, very slowly, and that's the key emphasis. The interest rates at the end of the day are controlled by the Federal Reserve. It has a big bearing on interest rate levels. The Federal Reserve has put its policy rate, called the federal funds rate, at 0%. It's been at 0% for 5 years. It's one of the reasons why yields are so low, why people's savings deposits are receiving so little, why their money market funds earn next to nothing. These rates are controlled by the Fed. It doesn't control longer-term rates, but longer-term rates will tend to be somewhat associated with short-term rates. And the outlook for short-term rates is simple. The Fed has provided a projection about what to expect for its policy rate, saying that we're unlikely to raise rates for at least 2 years, because it's providing thresholds for the unemployment rate and inflation by which it will make a decision. So to cut to the chase, the Fed is saying we won't be moving rates up for a couple of years, and when we do, we'll do it very gradually. A child born today will be in kindergarten by the time policy rate and the savings deposit rates and money market rates are closer to levels that people would consider normal, near 5 years' time from now. So expect rates to rise, but not much. And one final point, investors must remember why they own bonds in the first place, which is for stability and income and the chance at making money in markets. If they want to buy stocks, individuals, they can, of course, but would you drive a car without insurance? You only should take risk if you've got something to stabilize things on the whole. And bonds provide that stability that enable you to go and take risk in equities, because there's such volatility risk there that you wouldn't want all your eggs in one basket.
Thank you. We know banks are so central in any well-functioning economy. What your thoughts are regarding where banks are going and how they're going to face the regulatory environment that we're in?
The banking system has been critical to the U.S. economy and its strong growth of the past 30 years. There's been a large amount of expansion of credit. Since 2008, when the financial crisis hit the United States, bank lending has actually been a lot weaker. There were a lot of pressures on banks to raise capital levels, which is to say, if you're going to lend out money, you banks, this is what the regulator will say, you can't over-lever, meaning if you've got deposits, there's a limit to how much leverage we want you to take, a limit to how many loans we want you to take, a limit to how large we want your balance sheet to be. And so banks have shored up their balance sheets. They've raised capital. In other words, they've issued equities. They've retained their earnings. The numbers look good in terms of capital ratios, also in terms of leverage ratios. Leverage is down. They're not taking as much leverage. And profitability, based on the FDIC's quarterly banking report, are near record levels. So they are in better shape, but they won't be lending a lot anytime soon. An easy example is the mortgage market. There isn't a subprime mortgage market anymore, virtually non-existent. Banks are unwilling to lend. That's just one of many examples where banks are saying no to lending because they want to make their balance sheets stronger and be safer and sounder institutions. And this is the aim of regulators in the United States and globally, is to strengthen them so that there's no hit to the economy in the way we saw in 2008 from a cutback in lending all at once. And so the bad news in all this, and the good news is the banks are in better shape, far better shape, as I said, profitability at near record levels, is it means people won't be able to obtain loans in the way they used to. And it's difficult, as I said, to get a mortgage loan. And this means the economy won't grow as fast as it otherwise would. And it's one reason, though, why interest rates won't rise a lot, because typically they rise, the Fed raises interest rates, the Federal Reserve, to combat the lending practices, to reduce the incentive to borrow. But here there isn't a lot of lending anyway, and so this will wind up keeping rates low because you won't have strong growth powered by credit growth.
Sure. And since you spoke a little bit about the rest of the world, what your thoughts are, say, about Europe?
Global growth in 2014, PIMCO projects at around 2.5%, 2.75%. In 2013, it was 2.25%. The U.S., we expect between 2 and 2.5% growth, which is better than it's been. It's been 2%. Europe out of recession, but only meager growth, a little bit above zero. Japan, growth of 1 to 1.5%. China, strong growth, but slower than it's accustomed to, of 7%. And finally, in the emerging markets, Brazil, Russia, India, Mexico, combined 3.5%. So the story on growth is a little better, but PIMCO would characterize the global situation as stable disequilibrium, an oxymoron, to say things look good on the surface, but underneath there's fragility. Why are they stable on the surface? Because of central banks. They've done so much money printing and pushed interest rates so low that it's made the climate for financial markets a lot better. And you see the equity market in the United States with robust gains in 2013, indicative of this sort of thing. But under the surface, there's a lot of wood to chop. In the United States, of course, it hasn't been dealing with its long-term budget issues. Europe has major structural issues. This means it's inflexible labor markets, troubles with tax collection. China wants to change its growth model. Japan, from an export-oriented to something else. And Japan has lots of debt, but the central bank is kind of masking that. So you've got to watch your back as an investor. Things look okay in terms of black swan risks for next year, but keep watching your back, because these issues must be dealt with at the federal level, and they're not being dealt with just yet.
Well, Toni, thank you so much for coming out here. I appreciate your
really
thoughts.
Appreciate it. Thank you.